What's up, guys? Welcome back to GTech Finance. My name is George, and today we are here to talk about taxes because most of people pay a lot of taxes while they don't have to pay that much, and there are ways to avoid them, of course, legally. And these are five simple ways to avoid paying so much taxes legally, of course. But before we get started, if it'd be great if you just obliterate the like button for the YouTube algorithm. It would be awesome. And while you're at it, subscribe to the channel. We're trying to achieve 20 subscribers, and it would be absolutely awesome if we can do it. And let's get right into it. So, number one is a traditional 401k contribution. So this is a retirement account that's created through your employer, and that lets you contribute money and then reduce that from your taxable income. With the 401k, you're allowed to contribute up to $19,000 per year, which means the IRS will tax you as though you have made $19,000 less. For someone in a 24% tax bracket, this could save you from paying about $4,500 in taxes. If you're self-employed, you can open up a 401k too, but it's a solo 401k, and it's even better because it allows you to contribute up to $56,000 per year. Now, sometimes when you open a 401k with your employer, he offers you something called the 401k match, which means for every contribution you do in that 401k, he'd contribute the same amount with you, which means if you contributed the maximum $19,000 a year, your employer would add to these $19,000 again, which would bring it to $38,000. Number two, the traditional IRA. So it's a very similar system to the 401k, except anyone can open up a Roth IRA at any time. And the maximum contribution in this case is $6,000 per year into this account that would then be reduced from your total taxable income. Now, in this case, the Roth IRA, the money is taxed when you put it inside, but once you get it out, it's tax free. And let's say you open a Roth IRA, you put your $6,000 every year for 40 years. All of that would kind of an 8% interest if you put a low budget index fund, and you'd end up after 40 years with nearly $1.5 million tax free, which is absolutely amazing. Number three is the HSA. It stands for Health Savings Account. Assuming you qualify for the HSA, you can contribute up to $3,500 per year, tax free, into this account. And it's specifically used to pay any out of pocket medical expenses or charges that you incur. And if you don't use them 1 year, that's fine. You just roll over to the next year. Number four is the 457B. So this is for design people who are employed by a state or local government. So really not everyone can do this one. But with the 457B plan, you can contribute up to $19,000 per year and reduce your taxable income by that amount, which is exactly the same as a traditional 401k, and like mentioned in number one. However, the benefit to a 457 plan is that you don't need to wait until the age of 59 and a half to withdraw that money. You can withdraw it at any age upon retirement with zero penalty, which is great. Number five, the standard deduction. So this is the base amount that anyone is able to automatically deduct from their taxable income. Just because if you're single, you can take up to a $12,000 standard deduction. It's super easy. And if you're married filing jointly, it jumps up to $24,000. It's really straightforward, and for most people, this is an easy one to take. Now, there are some other stuff you can do, like let's say if you're self-employed, you can set up an S corp. So it's a legal entity that you create and you run your business through it. It means that all your self-employed business income goes into the S corp, and all of your expenses go out of the S corp. Distributions made by an S corporation are not subject to Social Security or Medicare taxes. It's meant to discuss with a CPA, which is a certified public counselor, private accountant, something like that. And if this is something that you're interested in, this is way beyond what I can talk about in a YouTube video. It's really huge. And you also have the long-term capital gains. So if you hold an investment for longer than 1 year, then sell it for a profit, it's taxed as long-term capital gains. This means that if you make less than 434,000 dollars, that long-term capital gain is capped at 15%. And you can also depreciate assets within your business. So in a business, you can depreciate certain assets over a certain number of years to offset earned income. Something like this is really a topic to bring up to a qualified CPA because every business asset has its own depreciation schedule you must follow. So I can't really do. And the last thing you can do to avoid some taxes legally is if you can hire a very good CPA, the best you can. So, of course, I'm not, it's by any means, this channel is only entertainment purposes. It's nothing out investment advice or anything. But because the tax code is so complicated and there are a million moving parts for each person that would be impossible to ever cover in a YouTube video like this, you must hire a CPA that really knows a lot of things about your business and your money, and he can find loopholes and ways to make you pay less taxes. So that's it for today. Thank you so much. Please don't forget like button, subscribe, and hope to see you next time.